What's up guys, Rick here, and today I want to walk you through the exact process of finding and choosing the ETF to invest in, and I'm going to make it as easy as possible for you. So if you follow these steps, you'll be able to easily identify winning ETFs amongst a jungle of almost 9,000 existing ETFs in the world. And in the end of the video, I'm also going to give you some ETFs based on different investing objectives that you might have, just to give you some inspiration. Of course, one of the ways you have to find new ETFs to invest in might be to get some ideas from YouTube. But the truth is, you can't always rely on ETFs that other people suggest. So for today's video, I'm going to show you a method with which you're going to use a couple of websites that are completely free to use. And I'm also going to explain to you all concepts about ETFs that you need to consider in your choice. So let's start. Before going through the important concepts and criteria that we need to understand about ETFs, let's do something practical. The first thing we're going to do is setting up a screener that we're going to use to filter the best ETFs for us. So what you're going to do is go to seekingalpha.com, which is completely free to use and is going to be one of your best sources for investing. Signing up is easy. When you click on sign in, you'll find create free account, and then either you have a Google, Apple or Facebook account, or you enter email and password. By exploring the site, you'll see that it covers a lot of topics on investing, but what we need right now is to go to ETF at the top bar and click on ETF Screener. So this is a tool that helps you screen through all existing ETFs based on particular filters that we'll see together. And by the way, you're going to be able to create your filters and save your screener so that you can easily use it again in the future. Of course, the job is not over with the screener, because after we identify some ETFs, I'm going to show you how to choose which one is the best to buy. So the first thing you do is you click on create new screen, and you're going to land on a page with just two filters. One is the fund type and one is the asset class and subclass. Before going through these concepts, let's click on advanced filters because we need to choose all the other filters. So let's start with the category ETF details, and here beside fund types and asset class and subclass, we're going to select AUM, assets under management, and also expense ratio. Then we switch to the category called performance, and here we select year-to-date performance as well as 5 years total return and 10-year total return. Move now to holdings, and here you select number of holdings, then to dividends, and here you choose the dividend yield TTM, which means trailing 12 months. All right, click on done, and you can save the screen as, I don't know, something like this. And then you can take a moment to go back to my video, and under the video you're going to find a thumbs up symbol that you need to click on, because otherwise the ETF screener is not going to work and it's going to give you the worst ETFs possible. Okay, this is not actually true, but any help from my channel is very welcome, and of course it's free of charge on your side, so thank you very much if you'll take the time to drop a like to my video. Alright, we've got a screener set up. Now let's dive into the importance of the filters. The first one is the fund type, and I'm gonna keep it short here. My humble suggestion is to stay away from leverage ETFs and inverse ETFs. Just focus on traditional ETFs and you're good to go. Simply explained, leverage ETFs use the so-called derivatives to amplify the returns of an index. The problem is that you have potential for bigger gains, but also for much bigger losses. Inverse ETFs instead profit when an index loses value. And in my opinion, there is no need to complicate things even more with them. After the fund type, we have the asset class. Now, this is probably the most important starting point, because the first question you need to ask yourself is what kind of ETF I want to invest in. You can choose, for example, the market size of the companies included in the ETF, which can be large, mid, or small, as well as the investment style of the fund, which can be value, blend, or growth. If you put these variables in a square, you can see that the more you invest into smaller companies and/or growth companies, the riskier the investment is, but also the higher the potential gains. Large companies tend to be more stable and safe, but at the same time, they're not going to be able to grow as fast as some small unicorn companies anymore. Value companies, which are mature and have stable financials, are surely safer than growth companies like Tesla, but also have less potential to growth. So for the average investor, I'd suggest large blend. Large because larger companies are safer, but at the same time, in index investing, they have performed much better than small company ETFs in the long term. And blend because it's a good balance between value and growth. If you are instead an experienced investor and you can better consider your predisposition to risk, you might move in other directions. Beside the investment style of the ETF, you can also select a particular sector, for example, communication, energy, financial, real estate, health, as well as international markets like China, emerging markets, Europe, and so on. In general, if you want to diversify as much as possible, you shouldn't invest too much on sector ETFs. A better choice is to invest more in general ETFs like large blend, and if you have some interest in a particular sector, you can also buy some of it. Alright, the next point is assets under management or fund size. In my opinion, a good ETF should have a minimum fund size of Some say $10 million, I would say 100 million. Managing less than this value means that there is less interest from the investors, and this translates into poor liquidity and wide spreads. Poor liquidity on one side means that it might become harder to sell in some critical situations. And wide spread means basically that the buy price is much higher than the market price and the sell price is much lower. Of course, if you're investing in a really particular ETF typology, it might be that there is nothing over 100 millions, but always keep these thoughts into consideration. Generally speaking, it's better to invest in some ETF that has a broad, widely followed index instead of some small ETF that has a narrow industry or small geographic focus. Alright, the next important parameter for an ETF is the expense ratio, or TER, total expense ratio. The expense ratio is the percentage of the ETF value that you have in your portfolio that the fund manager is gonna take as a management fee every year. So if you have, for example, an ETF with an expense ratio of 0.5%, every year you're gonna pay 0.5% of the value that you possess of the ETF. As a rule of thumb, I'd say that you should try to avoid ETFs that have an expense ratio over 0.30%. But the truth is, the smaller the better. All the most important ETFs from Vanguard, Invesco, iShares, SPDR, or Fidelity are under this threshold, so you shouldn't have any problem. The next filters are performance filters. Now, I chose 3 filters here because in the future you can play with them as you wish, but now I want us to focus on the 10 years total return. If you check the total return of VTI, which is the Vanguard Total Stock Market ETF, you see that in the last 10 years, it had a total return of around 217%. So in my opinion, I would probably not invest in an ETF that has a lower 10-year return than this, because if you do, you might as well invest in VTI, which will give you peace of mind because it has the widest diversification in the US stock market. Of course, this is only a rule of thumb, and if you want to invest internationally, for example, you're probably going to find lower performances than this. So feel free to play with the filter as you wish. And if you want to find ETFs that are younger than 10 years old, then you shouldn't use this filter because of course they're going to be filtered out. But I strongly suggest you to only invest in ETFs that have enough history of returns for you to see. Now we're almost done with the filters. The next one is the number of holdings. And of course, the lowest, the less diversified the ETF is going to be. As a rule of thumb, I wouldn't feel safe enough if I invested in an ETF that has less than 100 companies. So you can use that value here. I could have also given you another tip, that is to avoid investing in ETFs where the top 10 companies weigh too much compared to the others. I could also have used it as a filter, but I didn't want to complicate things too much. Now, the last filter is the trailing 12 months dividend yield. Namely, how much the ETF has paid in dividends in the last 12 months. And this is of course only relevant if you're interested in getting dividends from the ETF, but right now I'm going to leave it untouched. Alright, now we got the results of our screen and we can sort them as we like. Let's go for example to the top performance, and if we go to the right and click on 10-year total return, we see that the best performance in the last 10 years have been VGT, QQQ and IWY. VGT giving even more than 400% growth in 10 years. Now these ETFs are all based on a growth investment style, which doesn't come as a surprise since in the last 10 years, companies focused on growth have been performing the best. Nevertheless, I'm not saying that you should invest in one of these ETFs just because they had the best performance in the last 10 years. In fact, 2 weeks ago, I published a video where I explained that in the last 40 years, value and growth companies have been taking turns outperforming each other every decade. So the next decade, maybe value will outperform again. What I want to say with this is that it's really important at the beginning to define an investment style that you want to pursue. And this was the asset class filter that we've seen at the beginning. Alright, if you just choose an asset class like large blend, you're gonna see that the number of ETFs that comes out is gonna be strongly reduced. And if the asset class is a sector like communications, financials or real estate, you might even get 0 results. This tells you a lot about sector ETFs because it means that if you want to invest in them, you need to either pay more management fee or have an ETF with less holdings, which also means more risk, or worse than anything, accept a lower long-term return. And that's why, in my opinion, when investing in ETFs, you should mainly invest in broad indexes that embrace all the sectors, like something large value, large blend, large growth, based on the risk you're ready to take. But now let's say that you're indeed interested in growth, and therefore these 3 ETFs seem to be the best performance in the field. Thanks to the filters we said at the beginning, we are sure now that these ETFs are solid choices. In fact, they all have billions of assets under management, an expense ratio lower than 0.30%, or in this case even lower than 0.20. They have a good number of holdings and had great performance in the past. So now we gotta dive a bit deeper into these ETFs to see which one is actually the best one to buy. And to do this, there are 2 steps that we need to take. First of all, we're gonna look for the official pages of the ETF by just Googling the ticker. So VGT to get to the Vanguard Information Technology ETF, QQQ to get to the Invesco QQQ, and IWY to get to the iShares Russell Top 200 Growth ETF. You should always check the description of the ETF in the page because they literally contain all the information you need, from general information to the performance of the last 10 years, the price, the portfolio composition including the number of holdings, as well as the sector exposure, which is an incredibly helpful information, and details of the companies included. But in particular, there are two criteria that, if you did your job well with the screener, as I explained, shouldn't be a problem, but still it's really important to know them. One of them is the so-called spread between bid and ask, and you find it, for example, for the Vanguard ETF under price. This is the current spread between the price you would spend if you buy this ETF now and the price you'd get if you sold it. Together with the trading volume, the spread gives you an idea of how liquid the ETF is. And the spread should be as little as possible, while the trading volume as high as possible. And the second is the so-called tracking error. ETFs track indexes, and the difference in performance between the index and the ETF is called tracking error. If you check the performance of the ETF, you'll see that they also show the performance of the benchmark, which usually is the underlying index. In big established ETFs, this difference is usually really small, but it's always a good thing to check that the ETF doesn't differ too much from the performance of the index. The last step is going to be a comparison of these three ETFs that we're going to do with a website called portfoliovisualizer.com. I will write all the links in the description below, but basically what this website allows is to make a clean comparison of all the ETFs and stocks that you want. In order to use it, you don't need to sign in because otherwise you're going to have to purchase a plan. Instead, you go directly into Tools and click on Backtest Portfolio. This is going to open a page with a lot of input that right now we don't need to change. We are assuming we invest $10,000 and we leave 1985 as the start here. Let's go straight to the asset list and we write here VGT for the first one, QQQ for the second, and IWY for the third. Then we write that we're comparing three portfolios, each one composed 100% of one of the ETFs. Click now on Analyze Portfolio and you get the results. The first thing that I want you to notice is that although at the beginning we left 1985 as a start date, the website automatically starts analysis on the first date in which all three ETFs were available, which in this case was the end of 2009. You can see the evolution of your $10,000 investment through time and the value you'd have now. Now, first of all, let's take a look at the table. Investing in VGT, you'd have now $73,000, $156. Investing in QQQ, $72,801, and investing in IWY, $57,242. This might already give you an idea that VGT and QQQ are probably better choices for the long term. But let's look at the graph and see if we can make new deductions. What you can notice here, of course, is that the yellow line, which is IWY, has consistently been lower than the others, at least after 2016. But what's interesting to see is that Invesco QQQ was the strongest performer at the beginning, but VGT got closer in the last years and might outperform it in the future. I can't tell you for sure which one of these two ETFs is the best choice for you for the future, but what I can tell you is that having found those ETFs through those filters that we talked about in this video, we are sure that we only found sound ETFs and that if you invest in them, in the long term, you're going to have great results. Before we switch to a new video, I told you that I wanted to give you a couple of ideas about ETFs, so here we go. Number one is VTI, the Vanguard Total Stock Market Index Fund ETF. With an expense ratio of 0.03%, an average annual return of over 12% in the last 10 years, and over 4,000 companies covering basically the whole American stock market. Number two is VUG, Vanguard Growth Index Fund ETF. 0.04% expense ratio, over 13% yearly return in the last 10 years, and focus on growth companies. Number three is VT, the Vanguard Total World Stock ETF. With 0.07% expense ratio, this ETF gives you a mix of US stocks, Europe, emerging markets, growth, and value. If you want to know which are the best ETFs that you should invest in 2023, be sure to check out this video that I will link here and in the description below. If you enjoyed this video, don't forget to subscribe to the channel and show me some support by dropping a beautiful like to this video. I really appreciate your support, guys. I wish you a wonderful evening, and as always, I'll see you in the next video.